Hello traders, Gary Wagner here just after 11 o'clock in Honolulu, 4 o'clock in New York on Wednesday, the 17th day of December, 2014, and this is the Daily Report for Gold and Silver. Following release of minutes and a news conference held by Chairman Yellen from the FOMC meeting, which started yesterday, we have a return to higher dollar, strong equities, and lower gold. First, to gold, currently trading off about $7 on the day, 1187.70. That is the current print for the continuous contract of COMEX gold, just off the lows of 1183.10 and a high of 1203.80. Silver, on the other hand, is trading unchanged to nominally higher. You can see that on this daily candle here, currently trading at 1572. Now that puts it up roughly 1 to 2 cents on the day. The low is 1555, the high 1616. Quite a range today. We'll talk about silver a little bit more towards the end of the show. So traders, following the release of the FOMC minutes as well as a conference, the last FOMC meeting, of course, of 2014, we have a 200 point plus rally in the Dow Jones Industrial Average, tremendous rally in the S&Ps, as you can see from the low of, call it 1960 up to 2007, puts it up 30-40 points plus. We also had the dollar trading in unison with the equities markets. You can see that right here on this daily chart, back over 89, up near these most recent tops. And so we've got a return to some of the more traditional things that we've been looking at towards the end of this year. As we get closer to the end of the year, of course, I have been preparing my 2015 outlook. And in essence, right now, I'm looking at two distinctly different models or possibilities on how we might see next year unfold. And I thought I would spend a moment and really share them with you today. So of the two models, we'll go ahead and illustrate that. But this is the first model. This model is actually predicting or looking at lower pricing over next year, and fairly substantially lower pricing. It's really based upon a couple of factors. Most importantly, when we take a look at the longer term activity within the market, we have had a series at this point of lower highs. Now, we've also had a period of equal and now lower lows. That, to me, of course, signals a potential for further downside pressure in the market. More importantly, the fact that it could not, on this last rally, this $100 rally from these new lows at 31, go in and break out above either the resistance line or the former top, which was 1154, meaning we got a lower high again. That also beckons to me the possibility of lower prices. So within this model, I'm really looking at this price point here. This is 1180. We're right there. And then, of course, we have another one now at 1131. But the key is when we look at our long-term studies, and to do that, of course, I've really got to go ahead and compress this chart so you have a sense for what I'm talking about. But when we look at our longer-term studies and we consider the 1154, now that is a 61% retracement from this last major rally, call it 700 to 1900. 1154 takes you to a 61% retracement. If in fact we cannot make it above this long-standing resistance line, my sense is, and this model is predicting that we'll actually come down and could test the market as low as about 1080 to about 1032, and that would be based upon different Fibonacci studies as well as Fibonacci retracement and Fibonacci extensions that we have used to really come in and look at that. Also, the fact is when we do our wave count here, this was the bottom of wave 2. This is after the first part of this rally, which took the market, call it from 700 just above $1,000, I believe. 1250 was the actual high right in this area. If not, it was about, this is 1250 here, excuse me. This is just at about 1200 right in here. So any kind of a real break below this point would signal a return, I believe, to those pricing levels. Now, there's another model that I am looking at, and let's go ahead and explore that. Now, to illustrate this model, we really have to look at some shorter term studies because what I'm looking at is this most recent activity. And as this market has been coming down, we've had this succession, as we pointed out before, of lower highs. But we're also on the short term, just looking at this most recent rally, we've had a series of higher lows. Now, under this model, it's a little bit different because what this model is looking at is, yes, we didn't have the ability on this last clip up to actually go and take that out. So what if what we're going to witness is yet another compression triangle of sorts? And in a compression triangle, of course, we would begin to get a series of lower highs and also higher lows, and that, of course, would be tightening the range. Now, with that in mind, because we're looking at a recent rally and in terms of an actual wave count, we would be looking at that type of activity as kind of a wave two. And so if we were to see the model like this unfold, and the way that we'll know that is we won't get these clear breaks at 56 and of course at 31. Rather, we'll get a succession where the market will find support above this particular support line. So it will kind of oscillate here and here and here until it reaches the apex. If that is how this market unfolds, typically what we look for when a marketplace is consolidating in a compression triangle is to return to the most recent current direction. In this case, it would be up. So what we might be looking at is where the market comes down, we get this compression triangle, meaning a small wave two, and the breakout would be from the upside. Now, there's absolutely ways as this market unfolds that we'll be able to determine which of these two scenarios, if at all either of these two scenarios kind of work their ways into the market. And we'll be able to discern that fairly quickly as we get towards the end of this year, beginning of next. But as my subscribers know, we want to look at all of the potential and possibilities, and especially when I'm doing something like doing an outlook, I want you, our subscribers, to be the first to have a sense for what it is I'm looking at and the models that we're currently developing. So how does silver fit into our current models? Well, if we have a tremendous rally in the equities markets, we will get a little bit of bullish sentiment entering silver because it's an industrial metal, but more so in platinum and palladium, which are more heavily used in the auto industry. Of course, electronics is using a lot of silver, but my sense is that we would see silver continue under pressure if we see gold continue under pressure. And if we have the second of the two models that we're looking at, meaning the compression triangle and a breakout to the upside, we would see silver follow suit to the upside in that. So I still think silver is going to trade in tandem with gold. This has been Gary Wagner, wishing you as always good trading. Talk to you tomorrow for another daily update review. Bye-bye.